Matt Wirz is here to tell us how Warren Buffett ate Goldman's lunch. Can I say that he ate their lunch? Is that going too far?
Who's the Muppet now, Paul? That's what I want to know. Who's the Muppet now?
Yeah. How long were you thinking?
You know, I wish I could take credit for that. One of my sources that I talked about in the story.
Funny. All right, explain to me. Tell us about this story. Tell us what's going on.
Okay, so you know what happened? What happened was that Goldman Sachs, in the world of leveraged loans, which is basically junk-rated corporate loans, Goldman Sachs, for much of the 2000s, was the dominant, if not one of the dominant, market makers. What that meant was that they traded a lot with clients, BlackRock, hedge funds, etc. They also took proprietary investment positions. They bet on these loans. After the financial crisis, they scaled back, but they were still very big. And through 2010, they had roughly a $5 billion trading book, which in this leveraged loan market, which is very liquid, is huge. In 2011, after the first quarter, as we all know, Goldman decides that they want to de-risk. They're worried about the debt ceiling, they're worried about Europe, et cetera. They start selling, and then they keep selling into the third quarter. In the third quarter, clearly, all markets got volatile. Prices dropped, but in the illiquid leveraged loan market, prices cratered because there was no liquidity. So, you know, a loan could go down 20 points in a day easily. 20 points meaning 20% of the face value.
So Goldman wants to unload this stuff. And unloads it at a loss, right?
And they're so big that as they're unloading, they're pushing prices lower in a sort of a free fall market.
And we're talking about, here we're pulling up the chart here, we're talking about specifically Lee Enterprise loans, right?
Well, we're talking about, Lee was one of their, it was a large position for a bank to take, for any one bank to take on, but it was only, you know, it was a little less than $100 million on a at one point was a $5 billion book, then by the beginning of 2011, $4 billion. So, you know, it wasn't a huge position for Goldman,
right.
But look, the reason that position is that position was very interesting was that as they were selling, Goldman realizes that they're taking massive losses, and they're going to, for a variety of reasons, regulatory, the shift that you guys are talking in the street towards away from taking large risk and towards working with customers, they decide they're going to get rid of this big trading desk and sort of meld it with another one. As part of that process, they start selling some loans that actually, if they had held on to, would have done okay. They start just getting rid of them.
Getting rid of them, and who comes
in but Warren Buffett?
Now they don't know this at the time, right?
Well,
which is interesting too, because you know we know that he has worked a lot with Goldman Sachs. He's
rather intimately.
This is the painful irony, right? Is that he gave them $5 billion in 2008. He was paid out in early 2011. He had a close relationship with Goldman. He doesn't come directly to them to do this loan. He goes through Citibank.
Yeah.
It's a little bit of a slap in the face. And he buys it, by the way, you know, talking to a lot of sources, Goldman's cost on this loan, they bought it at around 80 cents on the dollar. He buys it from them months later at 65 cents on the dollar. Then I talked to a source late last week. He goes to another investor and he buys the same loan at 81.5 cents on the dollar.
Really?
Basically an 18% premium on what he paid Goldman. He fleeced them.
So, but he's probably still going to do business with Goldman in other ways now. So, you know, I think in your story it said that maybe Goldman took like a $13 million loss on this. Something tells me that business that they do with Warren Buffett down the road, they may earn back that $13 million in fees.
Sure,
right?
and we're all, you know, they're all big boys, right? I mean, they know this is an iterated game, and they're going to be playing it. But you know, it's interesting. You guys were just talking about this platform that BlackRock is launching. The game is changing,
right?
And what I see this as more emblematic of, the Lee trade was interesting, but you know, the bigger story behind it was the fact that Goldman was basically pulling out of this business, and they were selling out dramatically. It was a proprietary business and a client-focused business, and they were just basically getting out. We're seeing a power shift here. The power is going from Wall Street, which dominated the capital markets for most of the 2000s, and it's really going to the buy side. Now, you had the hedge funds in the mid-2000s that really stepped up, but it's been sort of an ebb and flow with them. Now we're seeing a paradigmatic shift, where really it's the investors that have the power. And a lot of that has to do with the regulatory environment. And, you know, I'm not taking a view on whether that's a good thing or a bad thing. All I'm saying is this is the reality. The reality is now the leverage is in the position of the buy side.
And I think technological change, too, is having an effect on all of this and all the markets. We have to leave it there.
Thanks,
Matt
guys.
Wirz, thank you very much.